According to a recent report in the Wall Street Journal, companies are buying back their own stock at an unprecedented pace. This trend has been fueled by the decline of interest rates and the rise of cash reserves among corporations. The data points from S&P Global Market Intelligence show that US companies have repurchased $1 trillion worth of shares in 2022 alone, with the total amount exceeding $4 trillion since the start of the pandemic. This buying spree has led to a surge in stock buybacks as a percentage of overall equity issuance. The catalyst for this trend can be attributed to several factors. Firstly, interest rates have been low for an extended period, making it cheaper for companies to borrow money and finance their share repurchases. Secondly, corporations have accumulated significant cash reserves during the pandemic, allowing them to pursue strategic initiatives such as stock buybacks. Another factor contributing to the record pace of stock buybacks is the shift in investor behavior. With the rise of ESG, environmental, social, and governance investing, companies are under increasing pressure to demonstrate their commitment to shareholder value creation through share repurchases. Furthermore, the growing popularity of activist investors has led to a surge in demand for companies to return cash to shareholders. The trend is not limited to US companies. Global corporations are also participating in the stock buyback frenzy. According to a report by Bloomberg, European companies have spent over $150 billion on share repurchases in 2022, with German and French firms leading the charge. Meanwhile, Japanese companies have bought back around 20 trillion yen, approximately $170 billion worth of shares since 2020. While the trend of stock buybacks at record pace may seem attractive, there are risks associated with this phenomenon. One potential concern is that it can lead to an increase in stock prices due to artificially inflated demand rather than fundamental value growth. This, in turn, can create a self reinforcing cycle where companies feel pressured to maintain their share price through further buybacks. Another risk is the potential impact on corporate governance and accountability. As companies prioritize share repurchases over other strategic initiatives, there may be concerns about whether management is making decisions that align with long term shareholder value creation. From a tactical perspective, investors can consider positioning themselves for potential gains in the short term by focusing on sectors or industries that are more likely to participate in this trend. Some possible levels to watch include key technical resistance points around 4 to 6% above current price levels. Alternatively, investors may want to wait for further confirmation of the trend's sustainability before entering the market. Some notable companies that have announced significant share buyback programs in recent months include Apple, AAPL, which has committed to buying back $90 billion worth of shares over the next 3 years, and Microsoft, MSFT, which plans to spend $60 billion on share repurchases between 2022 and 2024. Other companies such as Coca-Cola, KO, and Johnson & Johnson, J&J, have also announced substantial share buyback programs. One thing is clear, companies buying back their own stock at record pace will continue to be a significant factor in the markets going forward. As investors, it's essential to stay informed about this trend and consider its implications for your investment strategy.